Hello, good afternoon. Is everybody there? Can everybody hear me there? You can, just do me a favor. Um, on the bottom right-hand side, if you have this, see that arrow, actually on the top right-hand side, you'll see a little arrow, red arrow. If you click on it, it'll open up a sheet, and there's somewhere where you can see the word questions. Just say hello or something, and then I'll know that you can hear me well, okay? Anyway, as we start our webinar off today, I want to talk about something that really is not too cool, and it has to do with this, your mask. Please remember to wear a mask. It's not to protect you, it's for you to protect your friends, okay? Mr. Boris Johnson, Prime Minister of England, I hate to say this, but he is now in intensive care, which is not exactly the most fun situation for him. Okay, so we're going to start our webinar right now, and the first thing I'm going to do, actually, I'm going to move away from this presentation and move to what I'm going to be talking about, right, which is over here. Okay, did this go to, yeah, it went to full screen. Okay, great. So as we know, we're going to be talking about reinventing ourselves. And why reinventing ourselves? Well, we have to jumpstart our business. We have to see what's going to go forward as we move along. But unfortunately, because of legal reasons, I have to start with a disclaimer, because I will be talking about things that you may decide to do. And since this is a terribly litigious country, somebody may decide to sue me in the future. So my disclaimer is, number one, I am not an investment advisor, attorney, or financial advisor, and you agree that you bear responsibility for your investment, financial, and tax decisions. You agree that Robert Bull, me, is not and will not be liable for any investment, financial, or tax decision that you may take based upon what you're going to be hearing today, okay? And where am I now? And all information that I published was sourced from different locations that I believe are accurate and reliable, but there are no claims or representations to the accuracy, completeness, or the truth of any material that I have talked about. So before you make any decisions on any possible things you could potentially decide to go ahead and proceed with, please contact and deal with your own attorney, okay? So having said that, let's move on to why are we talking about reinventing ourselves? First of all, we do not know what we will find after this coronavirus crisis. This is very serious. I don't know. Some people are saying we're going to be out of the woods in May, beginning of May, maybe, but according to the doctors, Miami is going to hit the peak of our death situation at the end of May, beginning of May. Today, unemployment is probably around 20%. It's probably going to go higher. At this moment in time, there are over 10 million people who file for unemployment, and filing for unemployment has become so complicated that to get onto the state of Florida website, it crashed yesterday, went up again today. So I have no idea what it is, nobody knows. We do know we're going to face a huge calamity in terms of the GDP. It's going to be down 35% for the first quarter. And many people may need to reinvent themselves. So maybe they'll lose their job, maybe their company will fold, different things, who knows? Or maybe you need other sources of income. So that's what we're going to be talking about. How do we reinvent ourselves? And when we talk about that, we have to ask a question. Is money working for you? Do you have a job that provides for income and expenses? And what does job really stands for? Basically, job is an acronym for the following three words: just over broke. So if you got a job, you're just over broke, right? So what we want to try and do is through our job, get income and pay our expenses. And ultimately, we want to be able to build up assets, homes, cars, or whatever the case may be. And we're going to have liabilities, stuff that we owe. We're going to have assets, what we own, liabilities, what we owe. But our job is going to give us that kind of area. So that's when we're working for money. Or do we want the money to work for us? Well, what we ideally would like is our assets and liabilities, whatever we own or have and produce. And in this case, I'm just use an example of somebody who bought a truck to use for whatever case may be to ship things around. He has a liability, or you may have rental property or something. But these assets could potentially provide the income for you to live. And that's when your money is working for you as compared to you working for your money, okay? And so that's a key difference between being an employee and being an entrepreneur, a business owner, okay? Whether they want, as a business owner, you want the opposite. Now, in the United States, there's all different kinds of legal entities. I'm sure you can't see them all very clearly, but I'll do my best to bring them to you. Get rid of this. Okay. You have sole proprietorships, partnerships, or corporations. Sole proprietorship, I own the company, it's me. Okay. Partnership is something different. It's me and my buddy or two buddies. Now, what is it like in the United States? And here's why we have that paycheck protection plan or payroll protection plan, how we prefer to talk about it. I did a webinar on that the other day. It's so small businesses can afford and find a way to keep their employees working. And if we look here, you're going to see how do business entities break down in the United States by legal process, legal entities. Well, so sole proprietorships represent basically 70% of all the companies in the United States. In other words, all the companies in the United States belong to Joe Schmo. Whoever that Joe Schmo is, it really doesn't matter. Then you have partnerships, as you see down there. That's you and me, or you, me, and a buddy, or however the case may be, more than two people, or let's say two people or more is the proper word. And there are basically two other types of corporations. One is a C corporation. I'll get into that detail, but that's basically a corporation where there's shareholders, okay, and the corporation is its own legal entity. And the other one is an S-Corp, which I'd like to really call a glorified partnership. Okay, so let's move down and we'll talk about the sole proprietor option. And I talk about that, and I'm thinking about that because of one of the webinars before, I was speaking about this lady who wants to make these really great chocolate chip cookies, okay? And she's thinking what to call it, etc. So the sole proprietorship is one person owns that company, and that one person has unlimited liability for the enterprise. What do we mean by unlimited liability? Well, this lady makes a cookie, and somebody eats a cookie, and it has peanuts in there, and she didn't tell them it has peanuts in it, and the person gets very sick, and God forbid passes away. The parents or whatever of that person who passed away are going to sue that lady for everything she has. She'll have unlimited liability. That's why you need very good insurance, okay? Now, what are the advantages of a sole proprietorship? Number one, you keep all the profits. Number two, you hold title to all the assets of the firm. They all belong to you. Everything the firm has. In the case of that lady, it could be the ovens, the flour, the inventory, the cars, delivery trucks, whatever the case may be. And it's very easy to sell the company. You own it, you can sell it. There's no registration, no legal filing. You just start a business, not a big deal. And you really basically have absolute freedom from stakeholders, meaning people who you could owe money to, okay? So what are the disadvantages? Well, first of all, you bear all the business risk. You're subject to all the claims from the creditors. If you owe somebody money, they can go after you. As I said earlier, you have unlimited liability, and you have no great tax-free benefits as an employee because you're not an employee, you're the owner. So you cannot use insurance as a tax deduction, other sort of things. And if you pass away or become incapacitated, well, that's the end of the business, okay? And at the end of the day, you're limited to the personal capital that you can come up with. And all the profits are taxed as your personal income, okay? Now, is it bad to have a sole proprietorship? Of course not. There are many of them and they work very well. So there's no problem with that. Just go right ahead. If that's what you want to do, this lady, especially, the only thing I think what you got to do is make sure you have good insurance. Now, when you have a sole proprietorship, let's say me, okay? Robert Bull, that's the name, that's me. I could be Robert Bull Associates, Robert Bull, whatever the case may be. I decided when I came to the United States, I set up a not-for-profit. The name of that not-for-profit is over here. It's FESPA. It was first registered as a 401c3, which means a not-for-profit. And ultimately what it was an organization that worked with small, medium enterprises, helping them in a transition towards a globalized economy. I finally ended up not using that organization anymore, but I kept the name. And later on, I decided to make a DBA. What's a DBA? Doing business as. Well, here's the DBA. It's called FESPA. I kept the name. Does FESPA exist? No. It's me doing business as FESPA. And here I am. Okay. What are the difference between the two? None. Think of doing business as a nickname. Robert Bull's nickname in the business world is FESPA. And when I introduce myself as the owner of FESPA. With a DBA documentation, I can go to any bank and open up a FESPA checking account, savings account. I can have credit cards in the name of FESPA. It's basically, if you wish, my nickname. It's like me, but it's not me, but it is me. So I'm doing business as FESPA. But at the end of the day, FESPA and I were the same people. There's no difference. It's just my nickname. It is very easy to open up a DBA. Some people go to lawyers, they spend a lot of money. Do whatever you want, that's up to you. I went to sunbiz.org. It's right here, sunbiz.org. You go under the term of fictitious names, which is basically, think of it as a nickname. It costs you $30 to open it. You put a little ad in a newspaper saying, hey, this is what I did, and great, that's the end of it. When you file your taxes, it's really simple. There's something called, if you notice up here, it says the word Schedule C. You see that there, Schedule C, right there where my cursor's going? Okay, Schedule C. On the Schedule C, on that program, you put in here, you put what your revenue was, and you put all your expenses, whatever they were, your credit card expenses. You took a client to, I don't know, to have lunch. You went to any simple place that you could have gone to. You go to Starbucks, have a meeting. You buy your materials, your telephone, your car, your mileage, your internet, all these expenses you may have. How about your employees? Can you hire somebody? Of course you can. You can pay them a 1099. What does that mean? They're not your employee. They're somebody you contract to do a job. And at the end of the year, you give them a form called 1099, and I'll get into that later on. All of those expenses become, as you notice here, on the very top, it says profit and loss from a business. Okay, from a business. And you notice the word here, it says sole proprietor. That's you. You own that business. Okay, you can have a consulting firm. You can make cookies. You can do whatever you want. In fact, as an insurance agent, I work for Mass Mutual. I am what they call a statutory employee, which means they deduct Social Security from me, but nothing else. All of my expenses, I deduct on my Schedule C. So it's really very simple, very straightforward. As a sole proprietor, go ahead with that. Now let's move on to the partnership option. Partnership is you and me. We get together. Let's make a company. Let's make pizza. Why not? They don't want to go out. We'll make a pizza. Everybody's locked in their house, and we'll just call this, I don't know, let's just call it Il Forno de Miami. Okay, Miami Il Forno. Cool, great. So we form an agreement. You and I will own the company. The only legal requirements, we both have to be adults, okay, a legal age, and ideally, we both are honest, we're healthy, we're capable, and we're compatible, okay? I know how to make pizzas, you know how to do the marketing, we both have different things, you're gonna sell, I'm gonna cook, okay? We're both honest, we trust each other, great. So we got some questions. What are we gonna do when we started? First of all, what's the business concept? Making a pizza, that's very simple business concept. There are the kind of business concepts that are a lot more difficult where you talk about E-Trade, you talk about all these internet companies, whatever the case may be. How are we gonna structure the company? Well, wait, I know how to make the pizza. I'm worth more than you. So I'm going to have 60%, you're going to have 40. You may agree on that. We may not agree on that. If we agree on that, there's no problem. I'm going to put more money to start the company up. I have the capital. You have know-how. We can trade things whatever we want. Why do I need you as a partner? I know how to cook a pizza, but I have no idea how to sell. You know how to sell. Ah, okay, I need you. Do our lifestyles differ? Well, I'm married, I got 2 kids, whatever the case may be. I'm a family man, and you like to go partying in Miami Beach. Is that going to work? I don't know. We'll see. Very different lifestyles. Okay. So we got to be sure that as partnerships, we got to choose our partner very carefully. We got to be open. We got to be cautious about having partnerships with friends. Just because you and I are good buddies, we could end up being terrible enemies. We have to really understand, why are we being partners? What am I bringing? What are you bringing? What are my accountabilities? What are your accountabilities? What are our responsibilities? So we have very clearly defined, what do I do? What do you do? Okay. Hopefully, if we could, we'll test drive the relationships, and not always possible. And we need to create a combined vision for the company. When I'm using that word vision, if you go back 2 seminars before, in seminar number 5, I talked about preparing a plan for your business, a plan as you're going forward, a plan for what are we going to do after this terrible crisis. Well, one of the key things is having a vision and a mission and a plan. So before you even think about creating a partnership or any kind of business, you got to write down your plan, okay? All kinds of analysis are in that webinar number 5. Go ahead and look at it. As you know, it's free. All these webinars are free. We're just having a good time here together, okay? Prepare for the worst. What's the worst? Okay, you and I are partners. I drop dead. Stephanie walks into the office the next day and says, "Hey, Fred, how you doing? I'm your partner now. I own half of the company." Well, you may not want Stephanie as a partner. Or maybe Stephanie will say, "Okay, I want that. How is this going to work? Give me my husband's share." We need to prepare for the worst. Death, disability, and ultimately, we don't get along. We break up. How do we terminate this partnership? So we have to prepare that before we even start, okay? I have some simple suggestions for that. We can look at that later on. So what I do suggest you do is have a partnership agreement. Set up a little document that specifically says, what are my rights and duties? What are your rights and duties, okay? The other thing we have to understand is that we have joint and several liability. The liability of each partner affects and legally binds the other. We have a partnership and I signed a deal to buy 2 trucks for our business. Guess what? We're both liable. I unfortunately run over a little old lady in Hialeah. They're going to sue you and me because we're partners. So we have to have the right liability, the right protection, the right understanding. And I said before, we need to have some deal of how we're going to be able to terminate this partnership. Now, what happens with profits in a partnership? We're 60-40, whatever the case may be. At the end of the year, your accountant, hopefully you have an help you with the books, is going to issue something called a K1. You see it written up there? I have the cursor over here. Okay, K1. The K1 is basically telling the government what are the partner's share of the income, deductions, and credits. In other words, if I got 60% of the company and you got 60% of the company, the partnership doesn't pay taxes. I will pay taxes on 60% of the income, and you will pay taxes on 60% of the income. It doesn't mean the money came into my pocket, because we could decide we're going to keep some of the profit in the company as an asset, as cash, because we need it. So what I take out is not what I'm going to be taxed on. I'm going to be taxed on the profit of the partnership. Part of that profit could be retained in the partnership, or it could be distributed. But from a tax perspective, it makes no difference where it is. I'm taxed on the profit. Whatever stays in the company will be called retained earnings. It stays in the company. And when it comes out, it'll come out, I'm going to say tax-free, because I already paid taxes. So this is just a blank example. And right here, it says ordinary income. It's going to say, and there's other forms, other information on this data. But this is what your accountant will do. It's very simple. 2 partners, 2 K1s. 1 for you, 1 for me. 3 partners, 3 K1s. 1 for you, 1 for me, and 1 for the third person. That easy, okay? And it's really not very complicated. Now we're going to talk about a C-Corp. I do not recommend that anybody watching this video, unless there's a very, very specific reason, create a C-Corp. A C-Corp is an entity unto its own. You see the word here? It says a legal entity. From the company's point of view, from the government's point of view, the C corporation has shareholders, but ultimately, a corporation is a legal entity unto itself. It's like a fictitious person. It's an individual. It's a person. In Spanish, they say persona jurídica. which basically close to that would be a legal entity, a legal person, okay? So this person is what they call here in parentheses, you see it's an artificial being. The company can be sued, it can own property. Who owns the property of the corporation? The corporation does. We have a partnership. Okay, 50-50. Oh, let's make a mistake and make a corporation. You and I 50-50. Who owns the business? The corporation owns all the assets of the business. Not 50 me, 50 you. The corporation, okay? So they're chartered in the state, but they're taxed by the federal government. Here's the trick to this thing. I don't want to say trick. Here's the consequence. Corporations have to file income taxes. Partnerships don't. Partnerships issue K-1s, telling the government what's my share of the profit, what's your share of the profit. In the case of a corporation, it has to tell every year, it's got to tell the government what were the earnings, present the balance sheet, present the profit and loss statement, excuse me. And based on that, if there's a profit, the corporation pays its taxes. Mr. Trump lowered corporate taxes to 20%, okay? But they'll have to pay 20%, and I'll get dividends, which will be taxed, okay? So you gotta be very careful. So going on, there's another kind of corporation I talked earlier. It's called an S-Corp. The reason it's called S because in the IRS code, it's called subchapter S, an S corporation. Okay, S corporations are really, well, let's call them glorified partnerships, okay? Except that the shareholders are really not active. They're just people that are stockholders. You can have no more than 100. You can have 2, 3, 4, 5, whatever you want. They all must be individuals. Estates or trusts, in other words, it must be people. It cannot be another corporation that owns shares, okay? It has to operate on a calendar basis. What does that mean? January 1 to December 31st, just like you and I, just like a partnership. When we file taxes based on last year, 2019. Corporation files taxes, a C-Corp, based on its calendar year, when it was funded, created. 12 months later is the end of that year. It's a fiscal year, okay? Now, the interesting thing here, there's so many foreigners in Miami. Non-resident aliens cannot be stockholders. So if you have an uncle who lives in Costa Rica, guess what? He cannot be a stockholder. What you can do, you can create a different entity which create tax as a partnership, and yes, he can be a partner. But in an S-Corp, no, he can't. So what are the advantages? Well, liability is limited to the investment you put in the corporation, okay? And taxes are passed as your income through a K-1. You'll get a K-1 as well, okay? So there's another little thing where we talked about the partnership and talked about your uncle lives in Costa Rica, for example, okay? There's something called an LLC. You see here, limited liability corporation, okay? What do we mean by limited liability? Some people have the misconception that they're not liable in case somebody sues. I have a friend of mine who owns, I believe she owns 3 little schools. Okay, these schools are for underprivileged kids. The kids come in government programs, whatever the case may be. She has 3 of them. One in Homestead, one in Sweetwater, and the other one I have no idea where it is. Each one is a separate legal entity. Why? She's afraid of being sued. That doesn't make any sense at all. Because she has 3 LLCs. The liability that the LLC, that limited liability, that's not liability from being sued. That's liability from a balance sheet, which is assets minus liabilities, which means what you owe has nothing to do with being sued, okay? Nothing at all, okay? So if you notice here, it says stockholders have limited liability. That's liability in what you owe, not in what gets run over by a little old lady in Hialeah or whatever the case may be, okay? And you have to pay taxes on your business profits. They're super easy to set up. You can do it on sunbiz.org. The question you have to decide when you set up an LLC, and very often I run into people who have an LLC, and I ask them, how are you being taxed? And they all say, oh, I don't know. My accountant does that. I don't know. In Spanish, el contador lo tiene. Okay, what do you mean my accountant does that? No, 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 no. When you create an LLC, you can be taxed one of 4 ways. You can be taxed as a sole proprietor, which makes no sense to have an LLC as a sole proprietor. You and me. as a C-Corp, which would make no sense because then the company has to file taxes and pay taxes and you get dividends, or as an S-Corp, which is what I said before, think of it as a glorified partnership. I would recommend for people in Miami, if you want an LLC, I would do it as a partnership, okay? You can have active, passive partners. You can have master partners. Doesn't matter. All different kinds of partners. People really involved or people are just investors. If you're going to have a C-Corp, an S-Corp, excuse me, remember they have to be U.S. citizens or residents. So if you have an uncle in Costa Rica who's got a lot of money, he can't invest, okay? Let's skip over the professional corporation. That'll be for our lawyers, people like that, okay? And there's not-for-profits. They're called 501c3. That's the title in the IRS code. And if you want to make a not-for-profit, congratulations. But when you create a not-for-profit, you just create it, but you don't own it. A not-for-profit is a corporation, its own legal entity that was created by somebody that has to file its returns but doesn't pay taxes. But who owns it? It owns itself. What do I mean by that? Who owns itself? Interesting. Who owns the University of Miami? There's no answer to that question. Who owns the Red Cross? No answer to that question. Who owns the church down the street? No answer to that question. It belongs to who? It belongs to itself, okay? So a not-for-profit belongs to itself. A not-for-profit will have a board. You can create a not-for-profit. You can be the president of the not-for-profit. You can pay yourself a ridiculously high salary, as the president of the Red Cross earns a tremendous salary. The president of Baptist Health makes a tremendous salary. The president of the University of Miami makes a tremendous salary. The president of a not-for-profit little charity down the street probably doesn't make a lot of money, okay? But the fact is, you can create it, but you don't own it. There's no ownership to it. It's its own legal entity, okay? So if you want to create a not-for-profit, just be aware of that restriction, okay? So let's look at the tax returns very quickly. Sole proprietorship, you tax based on the income at your rate, whatever your personal rate is. You're making a ton of money, guess what? You're going to be taxed at the highest rate. You're making a little bit, it's a different story. Partnership, the partnership does not pay taxes. No, they're allocated based on the share of how much I own of that partnership, and they're taxed at my rate. Let's just say I have a very low rate. I pay 15%, but you as my partner, you're very rich. You pay 38%, 37%, whatever the max rate is. So the profit from the partnership, I'll pay 10 because I don't make a lot of money. But you have a ton of other investments. Government doesn't care. You're going to be taxed at your marginal rate, the 37%, okay? Downside. Now, a corporation, C-Corp, or a 501c3, it's a separate legal entity, but in the case of taxes, C-Corp pays taxes. It reports its income and pays taxes based on its profits, and then it can pay dividends. Dividends like you could own share in any company. Now, you can also own a C-Corp, and I have a friend of mine here who does own one, not too far from here. They created it that way many, many years ago. It's a mistake, but what can they do? He owns it, okay? He can draw himself a very high salary. He can pay himself a bonus. But the corporation has to declare profits every so often, because if it's continuously losing money, the government's going to say this is not a corporation, this is a hobby. You have people, for example, who breed dogs or breed horses, and they lose a ton of money. Well, guess what? If you lose money year after year after year after year, the government's going to say, well, your dog breeding business, it's not a business, it's a hobby. Okay, so you got to be a little bit careful when you're doing those kind of businesses. Okay, let's move on. Let's get into asset, it should be protection. I'm sorry for that mistake. Protection and tax planning, okay? Now you have the right to structure your business to minimize taxes. Remember, the government's key interest in you, they want you to create jobs, affordable housing, and pay taxes. If you look at the payroll protection plan or the paycheck protection plan, what's the government trying to do? They want to keep people employed. They'll lend businesses money to retain their workers, even though the businesses are shut right now in this crisis. And if you keep your workers employed for the next year, all that money will be a gift, will be a grant. What's the government want? They want employment, okay? So whenever you set up a business, you have to find a way of having what we're going to call here the corporate veil of protection. There's a wall. You see that wall there? We want that wall to protect and separate our business assets from me and my family. We want the two things going on. And when anybody's trying to sue you, and unfortunately this is such a litigious society that we live in, people will try and pierce that corporate veil and prove that you've commingled funds. What am I trying to say with that? I have separate accounts, separate checking, separate credit accounts, everything separate between my business and myself. I have credit cards that are named of FESPA. I have business accounts that are named of FESPA. In fact, guess what? In the credit cards, my wife and I have separate accounts. She has her credit cards. I have my credit cards. They do not mix. Why? Tell you a little secret. I pass away. I've already told my wife, do not pay the cards that I owe because you can't collect from a dead person. But if I give my wife a card on my account, or she gives me a card on her account, you know, the second user on a card, and you'll notice that cards always say, oh, you got somebody else you want to add. Why do they want that? They want you to mingle. Why? Because if they can't go after one, they can go after the other. But when you're separate, legally separate, and I don't mean it's legal from a perspective of you're separate from a marriage. No, no, I mean your business is separate. Whatever debt I have, they can't chase after my wife. Only in things that were joint, okay? So our business credit cards are separate. I recommend everybody do that. By the way, she has a much greater credit rating than I do. But anyway, it's good for her. All right, let's move along. And now we're going to talk about avoiding as compared to evading taxes. It is perfectly legal to avoid taxes. Everybody wants to avoid taxes. Why do you want to pay? So when you avoid taxes, what happens? Well, you have more money in your pocket because you're not giving it to Uncle Sam. And I just took a picture here. This is another place that's an investment center. I took a picture of myself there. And I said, okay, we're avoiding taxes. You got more money in your pocket. You can invest it somewhere. Now, what happens if you're evading taxes? Evading taxes. What happens then? Bum, 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 bum. Okay? Here's the problem. You'll go to jail for evading taxes. Al Capone, that huge criminal that everybody's heard about, he went to jail for avoiding taxes. They couldn't prove anything else on him. If he killed somebody, he didn't kill anybody, if he violated laws, who cares? The books got him, the taxes, follow the money, okay? So you do not want to evade taxes, which is illegal. Avoiding taxes is perfectly legal to avoid taxes. So we talked about legal structures before. Let me give you some little hints on ways that you could legally avoid taxes, not be accused of evading taxes, and not ending up in that jail. By the way, that jail, that's a picture of the jail in Homestead. Homestead, you know, is an older city in Miami, and that's their original jail that they had about 100 years ago. So I was just playing games there, having fun. Okay, so one way to avoid taxes is establishing a 401k plan. That's a savings investment plan that you can do in a company that you own, okay? You can have a SEP one, self-directed ones, there's all different kinds of them. I don't want to get into all the details, but let me just say the following. You can defer today meaning 2020, $19,500 of income. You can just take it out of your income and stick it into a 401k. And guess what? You don't have to pay any taxes on that until you take it out. Plus, you can add on, if you're over 50, another $6,000. Well, that's really cool. Once you hit over this huge amount of compensation, 280, it gets cut down. Now, the interesting thing is the following. If you own the company, you got a partnership, you own it, you're an employee in that partnership. You and your employee contribution have to be the less of 100% of your compensation. Meaning, if you're making $40,000, the most that can be put into an IRA is 40 between you and your employer. But if you're making a lot more and your company is making money, and I know we got some lawyers listening in on this conversation, and lawyers tend to make money, guess what? You can sock away $57,000, your contribution and your employer's contribution. And if you're over the age of 50, you can put yourself another $6,000, and that'll be $63,000 you can put away and not pay taxes now. You're going to have to pay taxes on them in the future, okay? When you retire and you take the money out, you're going to have to pay taxes, okay? So the limit in 2020 is $57,000 combined, you and the employee. This means together you can contribute the $57,000. You contribute $19,500, and your employer is allowed to contribute $37,500. And you add the two together, it's $57,000, and you can put in another $6,000, so you could put in $63,000 totally. Take it out of your income, put it away, boom, $63,000 a year if you're over a certain age, but if you're under, it's $57,000 a year that you can shelter this year from your taxes. Put it into 401k, watch it grow. You don't have to touch that money until you hit the required minimum distributions, which I just changed it to 72, but it used to be 70 and a half. But anyway, laws change all the time, okay? The other thing you can do to avoid taxes, hire your children as an independent contractor. What? You're going to say, why am I going to do that? Well, Mr. Lawyer, watching this program right now, I don't mention your name because some people here may know you. You have a kid. Actually, you have a teenage kid. Could that teenage kid help you with your website, help you with your Facebook page, help with your social media? Oh, really? He could. No kidding. Can you pay him for doing that work? Yeah, you can. Can you pay him for doing other jobs? Yes, you can. Do you have a gardener who comes to your house? Yeah. Is he an illegal Guatemalan or Mexican? Maybe not. But if he's legal, pay him and give him a 1099. But that's a different story. Okay, going on with your son. How's another idea? Have you ever seen children in commercials? I see them all the time right now in these car commercials. There's a little kid, oh, my daddy does this, Toyota, whatever. I don't know what they're saying, okay? They're on the commercial on TV. You can put your kids on your video commercials on your Facebook pages, your business Facebook pages, not your personal page, business Facebook page, on your business Instagram page, on your business LinkedIn, and you can pay that kid, your kid, as a model. Why? Because if you hire a model, you have to pay him. What makes your kid work for free? Nobody works for free, okay? Well, some people work for free, but you don't want them to. So you can theoretically, in reality, you can hire your son or daughter as an independent contractor, and at the end of the year, you give them a 1099, okay? Remember, you don't want them to be your employee. You want them to be your contractor. Why? Because if they're your employee, there's all a bunch of issues. You got to pay Social Security withhold. It goes on and on and on. If they're a contract, you don't have to withhold anything, okay? You need to be very clear in the scope of the work. What are you going to do? And you want to document what they want. If you have documentation, there's no problem. You got to document it, okay? You can't invent it. If you're inventing stuff, hiding money, then you're evading. You don't want to evade taxes. You want to avoid taxes, okay? Your kid will have to declare that income. Sure, you give them a 1099. File taxes. They won't have to pay taxes, okay? Why? Because they may earn 12 with zero income tax. That means you're cutting your income by 12 grand per child. If you have 3 kids, that's 36 grand. Wow, that's cool, okay? So notice here, this is a quote from the IRS. A child who only earned income, who only has earned income, must file taxes only if that amount is more than the standard deduction. Isn't that cool? 2019 standard deduction for dependent child was total income plus 350 up to a maximum of 12,200. So if they make 12,200, I put, they don't have to pay taxes. Guess what? Can your kid have a regular IRA? Yeah, you can put away 6 grand. So you could pay them 18,000, put 6,000 into an IRA, 12,000 into a regular account, and notice the very last line. Their income could be used for their own needs and well-being. Oh, the kid wants a car. No problem. Daddy's going to get them a car. No, the kid's going to get the car from the income he earned. So you could effectively buy the kid a car or lease him a car or whatever from their account. You pay it out of their account. And guess what? It's tax-free. Isn't that cool? So this is what a 1099 looks like. Very straightforward. You print one out, you have it done. Over here it says rents. It's not rent, is it? It's not royalty. You see the word other income right here? That's where you're going to put it in. You're going to see the word TIN? That's tax identification number. Your tax ID number, recipient. Who's the recipient? Your kid's tax ID number. Up here goes your address, their address. You live together, not a problem, but you have 2 separate tax numbers. Daddy, son. The son is an artist. How nice. Okay, that's really cool. Okay, another nice way of avoiding taxes if you're making a lot of money. There's something called an HSA. It's called a health savings account. These are great. Okay, and if you look at this, you can put away in the year 2020 $7,100, reduces your income, it's tax-free. Tax-free meaning you don't pay taxes on it. You put it into an HSA. If you're over 55, you can put another 1,000 in. That's $8,100 to lower your income. Boy, we already talked about a few ways to lower your income, not pay taxes. Isn't that good? The lower your income, the less tax rate you may pay. That's really cool. Okay, so you open up an HSA. What does an HSA do? It lets you put money away to pay for your out-of-pocket medical expenses. Now, if you have good insurance, you may not have it, but this is for your high deductibles, okay? And so what are you going to do? It's for high deductible plans. It lets you sock away this money for your retirement in many ways, and I call it a triple tax-free way. First of all, the contributions to your health savings account. I did it backwards. I'm sorry, my dyslexia really came in. I put HAS, it's HSA, health savings account. Whatever you contribute into it, the $7,100 for the family, and if you're over 55, you put another 1,000 in, so it'll be 8,000. Is all tax deductible, meaning you don't pay income tax on that money. All the capital gains, all the dividends, all the interest, that accumulates tax-free. And you could tell me today, God, tax capital gains, look at the stock market. Fine, buy bonds, you don't have to buy risky stocks. You can do whatever you want with your money, okay? But whatever's in there, it accumulates tax-free. And you have zero tax payments for any withdrawals for approved medical expenses. You need a CPAC. You can't breathe well. You need to buy one. Your insurance company's not going to pay all of it. Take it out of here. Guess what? If you don't have an HSA, it's after-tax payment. If you have an HSA, it's pre-tax, zero tax. All of a sudden, you hit the age of retirement. Well, there's two tricks to this thing. Before the age of retirement, if you take the money out, not only will you have to pay income tax because you didn't pay tax on it going in, there's a 20% penalty for taking it out prior to retirement. But if you take it after retirement age, it's taxed as ordinary income, just like your IRA is taxed. So think of this as a method of boosting your IRA. Okay, you can put money into an IRA. You can either do a Roth IRA or a regular IRA. It's up to you, whatever you choose. But think of it as you're part of your retirement plan as well. If you can put $8,000 a year away, that's really cool. So we're ready to wrap up. I just want to say the disclaimer again, because some people came in after. First of all, I'm not an investment advisor. I'm not an attorney. I'm not a CPA. I'm not an accountant. I'm not a financial advisor. You must bear all the responsibility of your investment, financial, and tax decisions. You agree that I, Robert Bull, will not, and I am not, and I will not be liable for any investment, financial, or tax decisions you make. All information that I've published here, I source from different publications, and I believe they're accurate and reliable. And there are, however, no claims or representations that they're accurate, complete, or truth. Please consult your own attorney, your own tax advisor. Please do that, okay? So to finalize, there we are. I want to thank you for attending this webinar. Our next webinar will be this Wednesday, 2 days from now. Its start time is going to be at 4. We're not having a webinar on Friday. Friday is Good Friday, and I know many people are going to deal with church, or they want to see stuff they're not going to go to church, but they may want to see it online, whatever the case may be. Please be very careful. Please wear your masks. Remember, the mask is not to protect me. I wear a mask to protect you. You wear masks to protect me. If the people in England were wearing masks, we wouldn't have Boris Johnson, the Prime Minister of England, right now in intensive care. And we know what the odds are of making it out of intensive care. In the US, 20% of the people make it out, 80% unfortunately don't. I hope that the Prime Minister makes it out alive. Okay, a video of this webinar, I say it's going to go out tomorrow. I don't know if I can get it out this afternoon, I will. Okay, it depends how quickly it takes to download. It takes a little bit of time because so many people are using social media today. If you have any questions, you can email me at my email address, which is rbull.miamirotary@gmail.com. You can look on Facebook. I have different things on Facebook, rbull, or you can go to my Facebook page, same way, facebook.com/FESPA Financial. You'll find me there. I also have a this video and all my prior videos are on. It's called FESPA, F-E-S-P-A. If you can't find it that way, it's going to be short url.at/b big D G M T. I'll have these connections on the email that goes out. The email will have links to this webinar, an invitation to Wednesday's webinar, and links to the prior 6 webinars. If you're going to be thinking about opening up a business using any of this information, please see webinar number 5. That's the one about planning. That's the one about having a vision, a mission, setting up your plan. What are your goals? What are your objectives? What are your strategies? What is your SWOT analysis? Strengths, weaknesses, opportunities, and threats. Look at competition. Look at your environment. What's going on? I have no idea what the environment's going to be when this crisis is over. This is a horrible plague, much worse than we imagined it to be. It is not killing the firstborn like the plague did in Egypt. This is killing anybody born, okay? So please be very careful. Please take care. Please wear your masks. Please stay home. Please be safe. And I wish you all the best as we go forward. And right now, I'm just going to end this webinar right now. Let me see. Oh, I missed it. That's a problem when I can't read very well. Leave webinar. There we go. So we're going to leave the webinar. Goodbye, everybody. Bye-bye. It's been a real pleasure having you here. I hope I can see you on Wednesday. Bye-bye.